one of the reasons why I love following the markets and analyzing and being an investor is because there's always stuff going on. Though I will say that Q2 had an extraordinary share of things going on. So we have an awful lot to be able to talk about today. Um, and after we get through the disclosure slide, I'll just kind of remind everybody of the types of things that we're going to talk about. So first, we'll go over market review, what's happened in the recent past, kind of frame everything because a lot has happened. It's easy to forget. Then we'll do an economic review, talk about where we are in the business cycle, some concerns we might have, other areas that we think are doing quite well. And then talk specifically about the stock and bond market and areas where we think that there are interesting opportunities or risks that we want to be able to highlight. Um, if you notice on the bottom of your screen, there's a little box that says Q&A. If you click on that, it will pop up a question and answer box. As we're going through this, please feel free to type in any questions. We'll definitely leave time towards the end to take those questions. But if they come in as I'm talking, I'll try to keep an eye there and address anything that you guys are curious about. For me, this is the most fun part of doing these webinars is that I get to hear what's top of mind for you. And I learn a lot from that. So with that, let's dig into the first portion of that is just reminding oh, actually, no, that's right. I have a couple of questions. So for those of you who have found that question and answer box, please click on that and we're going to have just a couple little trivia questions. So far year to date, so starting with January 1st to as of a day or two ago, which of these asset classes was the best performing? And we've given you a list to be able to choose from. So is it US stocks, non-US developed, so think like Europe and Japan, emerging market stocks, or is it in the bond space, investment grade corporates, US high yield? So these are generally like some riskier companies. Municipals, these would be local government organizations usually who are borrowing money, or things like commodities and real estate. All right, so I see a couple coming in, bonds, US stocks. This is my first seminar. Yay. Well, welcome. Non-US stocks, US stocks, non-US stocks. Okay, so we have a good range here of different guesses. And I don't blame you if you have no idea because so much has happened in the market over the last couple of months. So if we go to the next slide, here's the answer. And the answer is developed ex-US stocks. So as I mentioned, that's primarily Europe and Japan. And this is quite different than what we have seen for the last few years in that US stocks did fairly well, up 6%. Emerging markets did very well, up 15%, but developed ex-US 20% in just the first 6 months of the year. Within fixed income, those are those blue bars in the middle, you'll see like, reasonable performance, though interestingly, municipal bonds lagged significantly. And by comparison, commodities at up 5% look a lot less interesting, and US real estate turned down a bit. But looking at this, it really masks a huge amount of volatility, particularly in the second quarter. And I've called the first half of this year the Rip Van Winkle half year. Because if you had gone to bed on January 1st, looked at your portfolio, then woken up on June 30th, looked again, you would, for most investors who own stocks and bonds, you probably would have been up about, 5, 6%. That's a pretty good return for just 6 month period of time. You would have patted yourself on the back and said that, I did really well. But for most of us, whether we're investing or just read the headlines every day, we know that a lot happened during that time period. So the S&P from peak to trough was down about 19.5%. That means that we were like less than a percentage point away from an official bear market. And if you were looking at the NASDAQ, it was down a good bit more than that. So we had one of the sharpest, quickest drops that we've ever seen in US stocks, and we had one of the sharpest rallies back. So if you were making changes to your portfolio during that time period, there wasn't a lot of room for error because the market moves so quickly. So let's take a quicker look at diving deeper in there. So What was the worst performing Magnificent Seven stock year to date? So again, you can go back to that little Q&A box on the bottom. These are, seven of the largest companies in the world now, and have been huge drivers of the market over the last couple of years. And so, there's been a lot of press attention with it. And then we hear about these individual companies a lot, right? Plenty of you probably have Apple products, plenty of you log into Facebook regularly. Microsoft powers a lot of our computers. So they become very, very important, not just for the US stock market, but for the overall US economy. So I see here NVIDIA, Amazon, Tesla, NVIDIA, Apple, a lot of Tesla, Apple. All right, so if we go to the next slide, you will see it was indeed Tesla, down 18% so far year to date. And in fact, they were just on the wire earlier today talking about some difficult operating conditions. You'll see there, no surprise, NVIDIA was the best performer so far year to date. Interestingly, though, look at Apple down 14%, so almost as negative performance as Tesla. Meanwhile, Microsoft is up 20%, so almost as strong as NVIDIA. So I like to share this because we often talk about the Magnificent Seven as like a single group of stocks with very similar types of business models. And yes, they're all like tech related, but each of them does have very specific company fundamentals, and different things that will drive them over time. All right, so if we head to the next slide then, you can see from a sector perspective, some of the returns during the course of the first half of the year. And here too, like the sort of shape of this looks quite different than what we've seen over the last couple of years. For, let's see, 2023 and 24, technology was firmly over there on the left, the strongest performing sector. Communication services has been right up there. But you'll see technology sort of falls to the middle of the pack. Industrials takes a lead, which is really interesting. That's an area that has lagged quite significantly. And then you'll see all the way over on the right, consumer discretionary and healthcare in negative territory for the first half of the year. But that 8% return in technology itself even masks a lot of the volatility that happened during the first half of the year. So if we click forward there, actually, we didn't include that chart. So if we look at those particular sectors, another way of slicing and dicing their performance is to look at how much did they drop down by. So what was the max drawdown during that time period? And then what was the volatility on a daily basis? And what we see there is that technology had the largest drawdown, so it had the biggest drop, and then day to day had the largest amount of volatility. So again, if you own some of these names in your portfolio and you check your portfolio regularly, it probably looked very different day to day, because those names in particular were among the biggest movers on the upside and the downside during the first half of the year. Turning to the treasury market for a moment, because as much volatility as there was in the equity markets, by some measures, there was actually more in the treasury markets or the fixed income markets. So this is what we call a yield curve. This is looking at treasuries. So these are all bonds that have been issued by the government, and we look at different maturities. So what's the yield on a 1 month treasury, all the way out to 30 years? And the relative level of these yields will often tell us a lot about what the market is expecting. So typically over time, generally speaking, long-term yields are going to be higher than short-term yields. Makes sense, right? If you're lending somebody money for 30 years, you're going to want to get paid more for that than if you're lending somebody money for a month. Okay, so it makes sense. That sort of distance between the long end of the curve or those longer dated bonds and the short end of the curve is generally an indication of how much investors think the economy is going to grow and how much inflation will be going forward. Now, there are times when we get to an inverted yield curve. That means that it's actually more expensive to borrow money short term than it is long term. And so we've been in sort of extended periods where short-term yields are actually higher than long-term yields, which is very unusual. Here you see something even more complicated. So that light blue line is showing you where the yield curve was as of the end of June. So this gives you a good indication of where the market is today. And then that dark line is where it was as of the end of 2024. So in the first half of the year, right? So you have this like generally steepish yield curve, and then you have that middle part of the curve that just starts to drop. So it's created these like sort of strange anomalies. Um, Part of this is driven by tariffs and uncertainty and differing views about how quickly the Fed is going to cut rates and what that impact will be on inflation. But then if we look at some of these yields on a day-to-day basis, particularly after tariffs were announced, you see enormous volatility as the market's trying to churn through this new information and try to figure out, are tariffs inflationary? Do they depress economic growth? How sticky are they? And some would argue that it was that volatility on a day-to-day basis in this market that finally caused the administration to pause tariffs, that this was really where the pain came from that caused a policy change. And so that's part of the reason why it's so helpful to sort of like look at the treasury market to understand what this feedback is about different policy decisions. I'll mention one other thing in terms of like looking back at kind of where the market has been in terms of oil, which has been another really interesting part of the market. So this particular chart goes back to 2021. And so think about it, this is, sort of the middle part of COVID as supply chains are really disrupted. People are starting to buy again, but they're buying like goods rather than services. And so that's driving the price of goods higher. As part of that, oil also went higher. So you'll see there, it went from $65 to almost $130 in a fairly short period of time. So I'm going to guess that many of you have memories of trying to fill your gas tank during that time period and sort of being aghast at how expensive it was. And so that was a really huge source of pain during that time period. And it happened at a time when not just oil was rising, but other things that we buy every day, those prices were rising significantly too. So like eggs, steak, certainly homes, all these things were becoming much, much more expensive. And it was a key source of sort of like consumer angst and a big drag on consumer spending. But what gets a lot less attention is the fact that oil prices have retreated essentially from 130 to about $70 today. So almost a round trip relative to where we were 4 years ago. And this decline in oil has happened even as discussions around inflation continue, number one, and as we've had a tremendous amount of instability in the Middle East. So think what's happened in Gaza, bombing of Iran, Syrian leadership leaving, and sort of, a lot of instability there. Often when we see political instability in the Middle East, that will actually drive oil prices higher. And instead, we've seen the opposite. So the good news is this is a relief valve for consumers. Filling your gas tank is, a significant expenditure for a lot of Americans. They have to drive to work. And so as that starts to come down, that means a little bit more money in individuals' pockets. So there are always two sides to this. I think oil has come down simply because we've sort of seen more stabilization in where economic growth is coming from. But also it's helpful for individual consumers. All right, so with that, let's talk a little bit about the economy. We've sort of dipped in there a little bit. We have this economic dashboard that we put together. We update this actually on a monthly basis if you're curious. But the idea is like, what are the 5 main areas of the economy that we look at regularly, and where are they? Are they in the green and growing significantly? Gray is neutral, red is that it's in trouble and activity is really slowing down. So first thing I'll mention here is that if you look at where those indicators are, they're pretty much all in the center. And that means like a fairly stable economy. That's not a terrible place to be. And we could sort of like, quibble over exactly where each of these indicators goes. But I think what it does is it points to an economy that's on fairly solid footing. I know we talk a lot about, economic instability, whether it's because of tariffs or this inflation headwind or the Fed. But when we put it all together, we actually see, fairly solid growth. The one area that we did change this time that's worth calling out is housing. So you'll notice that is the one area that's in the red. Housing is typically very interest rate sensitive. So when interest rates go up, typically house prices or house activity at least will come down. Over the last couple of years, we've had interest rates increase significantly, but housing activity has really stayed in. That started to change a little bit, and that activity has started to drop. And we'll look at this in a little bit more detail in a few moments. But so this is a bit of a change going forward. So let's dig into this a little bit more. In terms of like the Fed funds rate, so the Federal Reserve is a huge driver of the economy and of the market overall. And when I started in this business 25 years ago on Wall Street, I sort of like grew up with this mantra of don't fight the Fed. And it is the single biggest sort of driver of the economic cycle. It's not the only one by any means, but it is a very, very important one. And so that's why you'll hear market participants talk about this a lot. What's the Fed going to do? Are they going to cut? Are they going to hike? Are they going to hold? And so what we're looking at here is what we call Fed funds rate futures. So there's this very active futures market that buys and sells contracts based on where those investors think that Fed funds rate is going to end the period. In this case, we're looking at year-end 2025. And so if we look today, expectations are for the Fed funds rate to end the year at 3.75%. In April, right before tariffs were announced, expectations were for 3.5%. So that means that between April and today, the market has started to increase the level of the Fed funds rate. What that means, conversely, is that the market has started to think the Fed will cut less. When we compare that to the end of 2024, the market thought the year-end Fed funds rate would be 4%. So we're still sort of in the middle of that range that we've seen so far this year. But this is an indicator to give you a sense of whether the market thinks the Fed is getting tighter or looser. Right now, the market has priced in about 1 to 2 cuts by the end of this year. Our guess is that the Fed probably doesn't cut in September at its next meeting. It does cut in December. And I will add, and if you're curious about talking about this a bit more, please put that in the Q&A and we can spend some more time on it. But there's this overlay of sort of political dialogue around the Fed. And that the president has talked about potentially firing the head of the Fed, Jerome Powell, or maybe appointing somebody else early, and really pressuring the Fed to cut interest rates. What I will say is that there have been many episodes over like the long course of the Federal Reserve's history of politicians, whether it's the president or Congress people or whomever, trying to pressure the Fed to move interest rates one way or the other, usually down, right? Because lower interest rates, people like that because then debt becomes cheaper. And so it is not uncommon for a president or a congressperson to be able to write a letter to Powell or to be able to give an interview with a journalist talking about how interest rates need to be lower. This sort of threatening to fire the head of the Fed is unique. We haven't really seen this before. And there's been a lot of discussion about what that would happen to markets. And I think it would be very negative for markets if we had this sort of destabilizing firing of the Fed. But because it would be so destabilizing, I think it's less likely to happen. So something for sure to continue to keep an eye on is very, very important to markets. But I don't think that we're going to see a change in this. I think we'll continue to see saber rattling. Okay, let's take a look then at manufacturing and services. So we actually just got some of these numbers over the last couple of days. If you guys have joined this discussion before, you'll have seen this chart or a similar chart. This is one of my favorite long-term economic indicators because it tends to be very accurate in giving us a picture of what's happening in the economy, and it's very quick too. A lot of economic data like gross domestic product, we have to wait months to get, and even then it gets revised, and so it is not very reliable because of that. This particular series, so if you look at that blue line, that's the manufacturing. Individuals will call out to supply managers at different manufacturing companies, and they have a series of just some quick questions. Is business better or worse? Are you getting more or fewer new orders? Are you hiring more than you were last month, right? So they run that down, and then they roll all those answers together, and then they come up with this index. So if you zoom in on that blue line over towards the right, what you see is that it's for like the last 2 years, it's been running under 50. Anything under 50 means activity is declining. So that's a pretty long period where activity's been not so great. The gold line is the same thing, but for services companies. So not companies that like make a thing that's tangible, but think like accounting companies. And what you'll see there is that while activity in services companies came down quite significantly in like 21, 22, 23, they've kind of held above zero since then. Very recently, we've had this additional sort of headwind of tariffs, where you can see that that blue line, those manufacturing companies started to see a resurgence in activity. Tariffs got announced, and that activity seems to become depressed again. Services have managed to sort of avoid some of that headwind, which kind of makes sense because they've been left out of the fray, if you will, when it comes to tariffs. Um, and if we look at the next slide, we'll be able to dig in a little bit more and see some of the components that are in that ISM manufacturing index. So remember, these are manufacturing companies. On the left, you see unemployment, where again, anything under 50 means contracting. So manufacturing companies continue to hire fewer people. And then on the right, you see how much are they paying for inputs. So you see that is increasing. This is likely tariffs, where either tariffs have already taken hold or they're anticipating that those prices are going to go up. So these two things combined have really sort of continued to pressure the manufacturing sector, which has not been able to sort of rejuvenate since the latter days of COVID. And turning to the consumer, then there have been some interesting implications on the policy side as well. We have a number of different surveys that are like this, and so they'll tell a somewhat similar picture, though they'll be like a little bit different. So remember that this is like one piece of the puzzle. But similar to the ISM manufacturing, this is one where pollsters will call out to people and they'll ask a series of questions. So there are a number of different sort of subcomponents to this, and then they get rolled up. This too has a really long history. It comes out quickly, and so it's a really helpful kind of quick look at how consumers are feeling. What you see there, so look all the way over to the right, and you'll see that big tick down. That is tariffs being announced, where things are starting to feel okay. Tariffs get announced, then all of a sudden the market sells off, and consumers are suddenly feeling very, very pessimistic about the future. That reading, which came after April, is look at that, among the lowest, was probably like the third lowest data point going back to 1978. That's quite extreme. If you look at that red line, that is the average level of consumer confidence during recessions. So when the economy is contracting, how do people feel? The answer is not great. But if you look at these readings from, say, like 2021 on, consumers pretty consistently over that time period were telling us that they felt as bad about the economy as they do in a recessionary period. So it's interesting though, like you can look at what people say they feel, and then you can look at how they're acting, and that's where it's a little bit different. And so there we look at retail sales. This particular series is looking at real retail sales. So we look at overall, how much money consumers are spending buying things in stores. We take out the impact of inflation, and then we also take out autos, which are very volatile. So the idea is, how do we get a sense of like how many more goods individuals are buying on a regular basis? So what you see there, like huge spike up during COVID, that was all the stimulus payments that got made. People had a lot more money in their pocket, so they used it. And then it came down quite dramatically. Again, makes sense. Those stimulus checks kind of dried up, spending normalized. As part of that too, in addition to the stimulus checks, we also had people who were shifting from services to goods, right? We couldn't go out to a restaurant anymore, so maybe you bought a new dining room table, right? So that goes into a different category. And then inflation started to take hold. So remember, we're removing inflation from this equation. So as prices went up, then real retail sales went down. If you're going to the grocery store and you're buying eggs are much more expensive. Maybe you'll buy a half dozen rather than a dozen. So that's that decline that we saw in 2023. As inflation stabilized, then real retail spending started to recover. And again, you got to look a little closely here, but if you look all the way over on the right, you'll see that real retail spending was starting to recover to a more normal level earlier this year, and then tariffs got announced, and then it ticked down a little bit. So we think in some cases, consumers and businesses pulled forward some spending before tariffs kind of took hit. Then tariffs were paused, and so there's some noise in the data. But in general, all of this is to say, consumers say that they feel really terrible, but when we look at what they're spending, it actually looks okay, a little bit below kind of what we would think is a normal level. But it's a good sign that people are still willing to go out to the store and buy things. If people were really worried about losing their jobs or, losing their house, this number would look a lot worse. And in fact, you can see what it looks like in 2008 during the great financial crisis. In that case, real retail spending declined by 10%. That's a massive, massive drop. The other part of this, I mentioned jobs, right? So it's very unlikely that people are going to be willing to spend if they're worried about losing their job or their spouse losing their job. And this has been a remarkably strong area of the economy. And so typically, as we think about kind of weakness or strength moving its way through the economy, um, it'll often start with the Fed, right? So the Fed starts to, let's say, hike interest rates. Then we'll start to see manufacturing hit and we'll see consumers hit. Job growth tends to be one of the last areas that gets hit because it takes a while to filter through. So as we talked about manufacturing being weaker, services okay, but still slowing, consumer spending getting hit. Jobs have been incredibly strong, and we keep looking, waiting to see this weakness. And when I talk to people about this, there's some surprise because certainly in headlines, we hear a lot about layoffs. So Doge laid off a lot of individuals earlier this year. We've had periods where technology companies have laid off a lot of workers. But none of those have really hit the headline numbers all that much. So we're seeing little sort of hints of weakness. And in fact, we just had some numbers come out this morning where initial jobless claims. So you lose a job and you go to apply for unemployment benefits. That gets counted as an initial jobless claim. Those have actually declined. I think we've had 6 weeks in a row of declines. Continuing jobless claims. So let's say you make your initial claim, 4 weeks later, you're still unemployed. You go back and you say, okay, I still need these benefits. I'm looking for a job. Help me out. So continuing claims have gone up. What that means is that companies are still reluctant to lay off workers, but they've slowed down their initial hiring. This here looks at employees on non-farm payrolls. So how many new jobs are being created on a regular basis? What you see here is that it's actually hanging in pretty well. Like if we're looking back over the last 12 months, these numbers are quite volatile. So that's why we have that 6-month rolling average there, but they look quite healthy. So then like going back to the Fed, as we think about if the Fed is going to cut, the Fed does like my argument, I don't think the Fed has to cut. The economy is actually in really good shape. Yes, it has slowed down in the second quarter with this policy uncertainty for sure, but job growth is really healthy. Consumers are still out there buying. Companies are saying that they're seeing new orders. So again, it doesn't mean that things aren't slowing, but I don't think that the Fed needs to ride to the rescue. Hence why we think that September, we're unlikely to see a Fed rate cut. Okay, but let's talk about housing because I mentioned that was the one area where we've started to see some additional weakness. And please, like, get up your Q&A boxes, and if you will, type in what is the average age of a first-time home buyer in the U.S. Now, and I'm going to show you in a moment data going back to the 1980s. And this has been like a big source of concern, and we track this a lot. Like, what are first-time home buyers doing? Because this is a key way that most Americans are able to build wealth over time. So let's say we have 32, 35, 30, 38, 40, 35, 38, 30. Okay, so somewhere between 30, 40 we have here. 40 plus a couple years, 30. All right, so let's see the actual data. The most recent data point had first-time home buyers at an average 38 years. And what's remarkable is that, so look at how much that has increased in just the last like 10 years. You go back to 2015 and it was 31. So it's gone up 7 years and just like the average age has increased by 7 years in just the last decade. And in fact, if you go back to 1981, the average age is 29. So this is like a huge source of consternation for the younger generation, right? So people are graduating from college, they're getting an okay job, but meanwhile they're paying off their student debt and they're trying to, excuse me, gather some money for a first-time home, and they just can't. They're priced out. interest rates are high, home prices haven't come down. More younger generation people are living at home for longer, more are getting help from their parents on a down payment. So this is a big source of consternation, just not just overall for the economy, but then as we think about this generational divide between new couples who are getting married and having kids and like looking to start to build wealth and feeling like they're left out of this opportunity. And this also comes as profitability has declined, no surprise, right? Because of that because of that higher interest rate, lower availability of homes. Naturally, younger people are being priced out. And John, if you don't mind moving to the next slide with the affordability. So this is looking at you've probably seen these numbers before, but we look at today's mortgage rates, then median income, and median home prices. So again, this masks a wide sort of range of experiences depending on where you are and what you're looking at. But if you want to buy the median priced home in your city and you have a median level of income and you're borrowing based on a mortgage today, how affordable is buying a home? And this series goes back to 2005. We're at easily the least affordable level that we've had in 20 years. So again, just to drive home how much of a challenge that is. And in fact, as of we've what is it, up 39% from pre-COVID. So that's a relatively short period of time to have this massive change in affordability. So for that reason, we're seeing more homes sort of like sitting on the market, and why we've moved that sort of housing piece into the red. One other thing I wanted to mention, which has gotten a lot of discussion, is the dollar. So in the first half of 2025, the dollar relative to a basket of other currencies has declined 11%. So this has gotten a lot of talk, especially as you have a new administration coming into the White House. This sort of aggressive new tariff policy, and how does that sort of impact our relationship with the rest of the world? And so to have all of that at the same time, the dollar starts to decline a fair amount. There's been a lot of discussion about what does that mean for U.S. investors? What does that mean for the U.S.'s relationship with the rest of the world? And on a very simple basis, if you remember, we looked at those numbers in the first slide. How did U.S. stocks do relative to non-U.S. developed stocks? And about half the outperformance that non-U.S. stocks enjoyed relative to U.S. stocks was simply because the dollar became less valuable. So as the dollar becomes less valuable, things like the euro and the yen become more valuable. If you own a stock that's priced in those currencies, you enjoy that increase in those other currencies. So this is something that will continue to generate a lot of interest, right? Because it feels like we're in the midst of this shift. And I would argue we're shifting from a very unipolar world over the last couple of decades to something that's more of a multipolar world. And again, if anybody's curious, we can dig into it some more. But to put this in context, 11% decline in the dollar is meaningful, but we've seen much greater declines over time periods if we look back to 1969. So again, this is not sort of without precedent. When we have typically seen the US dollar decline compared to other currencies, non-US stocks tend to fare very well for US investors. So this is also part of the reason why we think it's really important to have exposure to stocks outside the US, because these shifts do happen and they can happen for an extended period of time as well. All right, with that, let's talk about the stock and bond market. And in the second quarter, it was sort of hard to talk about the stock market without talking about tariffs. We've already hinted at it a couple of times so far in this period. Here, the patient saying, I'm dizzy, I'm nauseous, my head is spinning, I feel like I have vertigo. So the doctor says, how long have you been a U.S. trade representative? I think you could put like a lot of different sort of titles in there because there are a lot of folks who are focused on policy who might admit to feeling this way. You might be just an equity investor and say that I'm feeling dizzy and nauseous. So with that, let's take a look at kind of what was happening under the hood a little bit in markets. And so that gold line there, so here we're looking at equity markets starting the beginning of the year. That gold line is the S&P 500, right? So this is, good representation of the largest companies in the US. And what you see there is that really big drop. We mentioned 19.5%, I think, peak to trough. And then we're back up like 6, 7% so far this year. Great. And then if you look at the green line, that's Russell 2000, that's small companies. You can see still haven't really recovered from that drawdown. And then the Magnificent Seven. So we talked about some of those seven names, and you'll see how, number one, I would note that those stocks peaked actually back in January. So many of those names started to falter well before any tariff announcements or anything else. You can see in April how that really drove a big leg down. But since then, there's been this sort of like rejuvenation of excitement about what artificial intelligence can do. We've seen higher expectations for some earnings going forward, and with that, a lot of those names have been able to recover. But I share this because, again, if we were Rumpelstiltskin, we would only look at the results so far for the first half of the year, and we would ignore what happened during that time period. All right, so what really drove this? Ultimately, the US market is going to respond to earnings. If current earnings are growing at a decent pace and expectations for future earnings are positive, then the stocks are generally going to do well, right? The more companies make, the more they expect to make in the future, the more excited we'll be to own those stocks. And again, there's been a fair amount of noise with earnings, in particular in the first half of this year. So on the left, we have earnings revisions for S&P 500, so that's large cap, S&P 400, mid cap, S&P 600, small cap. So typically, when analysts begin to estimate how much a company will earn over the next 12 months, they tend to be pretty optimistic when they first put that number out. As time goes by and they get closer to the companies actually reporting those numbers, those earnings estimates tend to come down. So that like 3% decline is the difference between what analysts expected large cap companies to earn at the beginning of the year, and then about at the middle part of the year. So it came down about 3%. That's actually a pretty typical decline. And then when we look at mid caps and small caps, those declined 9 and 11%. So there was a lot more sort of downward revision for what analysts expected these companies to earn in the back half of the year. On the right, you'll see these actual earnings numbers by quarter. And so one thing so one of the reasons I think why some of these Mag 7 have been able to recover is because they haven't seen the same level of down or revisions that some of their smaller peers have had. That said, when you look at the fourth quarter of 2025, those three bars look pretty similar. So the expectation is still that those smaller names begin to start to catch up with the earnings growth of some of the larger names. And so again, another reason why we think it's important to have exposure not just to those really large names, but also to some of these smaller names, because the expectation is that they'll also see an increase in earnings, even though it's taking longer than some of these larger companies. The other piece of that puzzle is valuations. So if we all agree a company is going to earn X, how much more are we going to pay for that earnings? And so that's what we call price to forward earnings. So stock price relative to earnings for, let's say, over the next 12 months. So this is looking back about 25 years. And what you'll see here is that, today at about 22 times, we're close to the highest level that we've ever been in 25 years. You'll see we were there at the beginning of the year. We were there in 2021 during like the COVID rally, and we were there in 2000. Now, we can be there for quite a while, right? Just because you have high valuations doesn't mean that it has to retreat and valuations have to go down. But what it does mean is that the bar is set pretty high. And I think, if you go back to the beginning of the year, the PE on the S&P 500 was about 22 times. And then all of a sudden you started to have this concern about earnings slowing down. You have tariffs being announced and disrupting businesses. And remember that those Mag 7 names declined much more than other parts of the market. That's because they were among the most expensive. Now they've recovered because earnings expectations have recovered. So what this just tells you is that as long as the earnings picture remains as positive, then names can continue to have these high valuations. But as soon as that earnings picture changes, then there can be some potential downside. So something to be aware of. Beyond that, I want to dig into US versus non-US a little bit. So this is a closer look at the dark line is MSCI World ex-USA. So this is taking the whole world market cap and then pulling out the US. And then the gold line is S&P 500. So it's a proxy for the US market. So what you see there is for most of the year, right? Starting from pretty much, in January, non-US stocks have been able to outperform US stocks. Now, if you go forward or look back, I should say, on a more historical level, we can go all the way back to 1974 and compare when the US is outperforming. If this blue line, if that's going up, that means the US is performing better. If it goes down, it means the US is performing worse. And again, we have long periods of time when the US is outperforming, and then also some decent chunks of time when the US is underperforming. If you look, essentially since 2009, US markets have outperformed non-US markets. So that's a pretty long length of time. And if you go back to the financial crisis, there was a lot of focus on the fact that the US regulators were much more directive in having banks like repair their balance sheets and take losses and be able to rebuild more quickly. And then during COVID, the US government was much more stimulative than our peers. And so those two things alone were really big drivers of US outperformance. During that time period, US earnings growth has also been stronger than non-US earnings growth. So there have been some really good reasons why US has outperformed. Now that gold line is what's happening to the dollar. We talked about this a little bit more earlier in that the dollar can be a big sort of driver of returns, US versus non-US. And what you see there generally, like when that gold line is going up, the blue line is also going up, but by different magnitudes. So what that means is that the US dollar isn't the only driver of whether or not the US is outperforming versus non-US. So now roll forward to today, and most recently we have US dollar underperforming and sort of a resetting of expectations in some ways for US company earnings growth. And those two things together have helped led to this underperformance of US so far this year. So again, this is a good example of why we think it's important to have exposure outside the US, because if you look at just the past 10 years, US has done, has outperformed handily. But then you look at the 10 years before that, and non-US outperformed handily. So it's very difficult to identify when that turning point is going to come, but you want to be there. You want to have that exposure when the turning point happens. I'll just note briefly in terms of valuations. So this is looking at valuations around the world. If you remember in that previous chart, we looked at valuations in the US over time and how the US is among the highest levels that we've seen in 25 years. Here, those blue bars is the range of valuation within each of those regions. The dot is where it is as of the end of the second quarter, and then the line is the average over those 20 years. So what you see is that the US, which is the second bar in, is one of the only areas that is significantly higher than average. Europe outside of the US is about in line with its average. The UK is actually cheaper. Emerging markets a little bit more expensive. China a little bit cheaper. So this differential between the US versus non-US, and then the US versus its own history all suggests that US stocks are priced pretty high today. Again, that doesn't mean that they won't turn down, but they need to continue to earn in order to justify those higher valuations. I want to make sure that we leave time for questions, so please feel free to add anything in there. But a couple more slides before we do that. And one is to touch on fixed income. So one area that we look at is credit, right? So we have high grade or corporate credit, which tend to be like pretty mature companies. They typically don't need a lot of debt, but they're seen as very reliable borrowers. And then there's also high yield. Those tend to be companies that are smaller, less mature, rely much more heavily on debt, and can be an interesting like bogey to give us a sense of where the economy is. And so on the left, we have bankruptcy filings per year. And you'll see that blue bar, that's for the first half of the year. And it's just helpful so that we can compare to previous years. And what you see is that blue bar is the highest that we've seen since about 2010, but not by a huge amount. So we're seeing little signs that maybe there's a little bit more stress in the corporate sector. Number of bankruptcies are climbing a little bit. But if you compare it to say like 2010, there's nowhere near kind of that level that we're seeing. And then on the right, you can see some of the sectors that have been most hit. Industrials and consumer discretionary are among the highest ones that have been most impacted, but it's pretty sort of spread out among different types of industries. Now, it's worth noting that this like somewhat additional level of stress is happening when spreads are narrow. So let me explain what that means. When we compare how much it costs a high yield company, so remember, this is like a smaller, less mature, more levered company, how much it costs a high yield company to borrow versus, let's say, a treasury, that's the spread. When that spread is wide, that means the market is saying, "Hey, high yield company, I'm really worried you're not going to pay me back. So you're gonna have to give me some really good yield to justify me lending you money. If not, I'm just going to go to a treasury, right? So when that spread is wide, that means the market is worried about these companies not paying back their bills. When spreads are narrow, the market's like, yeah, you're going to pay me back. I'm not worried about that. You don't have to pay me all that much. Right now, we're at this level. We're at a place where spreads are very, very narrow. So if we ever saw this picture change and we saw a significant increase in bankruptcy filings, then we would be worried about that credit spread widening out or those names becoming much more risky. So we still think it's a fruitful area and we think it's an interesting place to be able to get additional yield. And so we think it's important to have exposure to these types of companies, but something that we're watching. All right, let's touch on tariffs. I feel like a lot of people are sick of talking about tariffs, but I would be remiss if I didn't have at least one chart on it. And if you're curious, we've written about this a lot. We have a bunch of different videos if you want to dig into it a little bit more. And as somebody, so before I started on Wall Street 25 years ago, my background is actually in international politics. And I spent a lot of time as an analyst sort of covering some of these different markets. So this kind of stuff I find endlessly interesting. But so here you can see the average tariff that was collected relative to all imports going back over 100 years. And you can see that we sort of annotated a couple of different points along the way. For over 100 years, this was essentially heading down. And this tells you that US policymakers and non-US policymakers, our other trade partners, were in agreement that more trade is better, fewer barriers to trade is better. And so you see that tariff is just one of the ways to measure this. So you can see tariff rates coming down. That changed during Trump's first administration. So for the first time in a very long time, we started to see a higher level of tariffs. Now, what was interesting is that most consumers didn't really notice that increase in tariffs. It was modest, when you look at it in this context. But because it was only applied to like a relatively small part of the economy, most consumers weren't really affected by it. Now you can see that chart on the right where we zoom into what's been happening over the last couple of months. And you can see that huge jump up on April 2nd. And then you can see some coming down and then climbing back up again. And there's been a fair amount of debate among like policymakers and academics and investors about like where exactly are we, right? So number one, it's been changing so quickly. And sometimes it's not even clear what the rate is or whether it'll be implemented. And then there's also what are the downstream implications? So, let's say washer dryers have a 25% tariff if they come from China, but it's only 10% if they come from Vietnam. Vietnam currently doesn't have a whole lot of manufacturing of washer dryers right now, but they have this huge price advantage. So maybe by next year they will. That's called like a substitution effect, or maybe we'll just buy washer dryers that are made in the US. It's hard if we don't know where the starting point is. We don't know how much companies and individuals are able to sort of trade off, saying, okay, I don't want that higher cost item. I'll find a lower cost item here. So this is still far from settled. I expect that we'll have some additional sort of puts and takes over the next couple of months at least. But here's the important thing to remember. When the market bottoms, or I should say, the market bottomed on the day that the tariff pause was announced. This is after the market had declined almost 20%. Treasury markets were in a tailspin. And the government said, okay, we're going to pause to give everybody time to negotiate deals. In my mind, that signal was that the administration is saying they are not willing to accept a recession because that's what the market was saying. The market was saying we expect a recession because of these new tariffs. The administration had said we're not willing to accept a recession in exchange for this sort of tariff policy. Now, we don't know what the policy is yet. We know tariffs aren't going away, but we also know that they're not going to be so bad that they force the economy into a recession. It's going to be somewhere in between. And so from an investor's perspective, that's been very, very important, right? We can sort of take recession then off the table, at least a policy-induced recession. So that's been able to give a floor to the market. With that, I always like this other chart looking at how the market has performed going back, back to 1980. So that red dot tells you the max drawdown. So at any time during a calendar year, what's the maximum amount that the S&P 500 has declined? What you see there every single year, the market has been down at some point. But in most years, the market ends up over that time period. And sure enough, as we map out what's happened so far in 2025 with the decline of 19% and up about 7% so far this year, we actually look like pretty normal. Again, it's hard to believe having lived through the last few months, but it's helpful to remember that this type of volatility happens. What drives the volatility is generally unique in every instance, and that's why it feels so scary every time you're in the middle of it. But this does happen, and this is just the market digesting, trying to figure out how these things are gonna impact the market overall. So the last thing I am going to mention, this is one of my favorite charts. This was put together by Professor Jeremy Siegel. He's on CNBC all the time. He's written a ton of very long books, fascinating guy. He and his graduate assistant started collecting all this data on different asset classes going back to 1800. And they did this in the 1980s. So this is, when you're still on, a lot of it I think was on handwritten charts and whatnot. But they not only were able to get prices for these asset classes, but then they took out inflation. So remember, this is the same exercise that we did with retail sales. So they pulled out inflation so that they were able to sort of think about these asset classes as a measure of wealth creation, and to be able to compare different time periods. And what was very interesting is if you look, so stocks far and away are the best sort of performer over time. And we talk a lot about how on a daily, monthly, annual basis, stocks tend to have a fair amount of volatility. They tend to jump around a lot. We've just lived through that. But if you sort of back up a little bit, they actually have the best track record of being able to grow wealth over time. You'll see bonds are actually pretty good. They're there in second place, and they do that with much less volatility on a day-to-day basis. I always like to point out gold here, and I'm not a gold hater, but I am a believer in sort of like long-term data. And what you'll see here is that gold has performed very, very well over the last couple of years. But if you go back over this couple 100-year period, it actually doesn't have a good track record in being able to build wealth. We've done some work looking at trying to identify under what circumstances gold does well, and it's not all that consistent. And of course, if you just own the dollar, if you just have cash under your pillow, that decreases over time once you take out inflation. So something to keep in mind, and I think a really powerful illustration of why we really believe stocks and bonds are a great way to grow wealth over time. So with that, I see that we have a couple of questions here. Let me just run through those really quickly. So I'm curious, explain more about how the decline in the dollar affects stocks. So this is a great question, and it is not very intuitive. So think about how, let's say you own US stock, let's just call it US stock, and it's priced at $100. And then you buy French stock, which is at 100 euros. And then all of a sudden, the dollar starts to decline and the euro increases. You still own one share of each of them, but this is suddenly worth more simply because the euro has appreciated, right? So if that makes sense, I know it's a little counterintuitive sometimes, but so anytime the dollar is declining, it's good for anything that's priced outside of the US. This works too for, let's say, like manufacturers or anybody who does trade. If you are, so let's imagine that you build a widget for $5 and you sell a lot to Europe. And then all of a sudden, the euro starts to increase in value, the dollar decreases in value. And let's say a European buyer with their same euros can buy more of those widgets simply because the euro is more powerful. Think about it when you travel outside the US. And in fact, we did this. My family was in London a few weeks ago. My husband found like 100 pounds that he had had from a trip he had taken like 20 years ago. And we were trying to figure out, could he buy more today with that 100 pounds than he could last time he was there? Unfortunately, the US dollar had declined 10% by the time we got there so far this year. But holding that pound, right, can buy you more or less depending on when you go visit London. So hopefully that's helpful. Next question, will this deck be shared? The answer is yes, it is available. We will send it out to anybody who signed up afterwards, so you'll have a PDF version of it. And if you're curious and you're desperate to hear me yammer on yet again, we'll have this available as a recording as well. So a good question, is there a chart of bankruptcies based on small, medium, large business filings? So we don't have one, but the answer is that the vast majority of these bankruptcies are among small companies. So only because like you tend to not have that many like true bankruptcies for large companies. They tend to just get gobbled up by a competitor. But so like when you see that, when you see those data points, like assume it's a good proxy more for small businesses than it is for large. Back to the steady decline in unaffordability of housing. Is there a correlation between this and institutional buying of homes? So somewhat, yes. Coming out of the global financial crisis. So if you remember, housing prices declined for the first time on a national basis, I think in our country's history. And you had a huge number of individuals who could no longer afford their mortgages, who weren't able to sell their homes anymore. You had foreclosures, it really like painful time period. So you had an enormous amount of homes that were for sale in different locations. With that, you had some really large institutional buyers that put money together to go and buy out chunks of homes. And the idea was, okay, this is a market opportunity. We're going to buy these, spiff them up, rent them out. And this is where it can be very, very regional. So every city can have a very different experience. And some cities where you've had really large institutional buyers come in have had a much bigger impact on the overall market. So I would say on a national basis, it's more muted, but in some locations, it can be really meaningful, especially in areas where you've had really large build outs. So certainly something that I think can be very impactful. And then you also have things like the Airbnb effect, where you have in certain locations that are popular with vacationers, individuals or companies buying up housing units to then rent them out, right? And then if you're somebody who wants to live there, it's much more difficult to compete. So definitely adds to the stress in the housing market. Where does physical real estate fall on the last chart about wealth creation? So that is such a great question, and we don't have that data. And I wish I did, but unfortunately, it's hard to get that far back. We will continue to look for it. The other thing to remember that's really unique about real estate is that typically a big part of the return comes because we're borrowing money. So think about it. You buy a home for $100,000, you put down 25%, you only need $25,000 initially to buy that. And then the house grows to say be worth $150,000. Your $25,000 gets turned into $75,000. So that's a really great return. And so that leverage piece is a really important piece of it all. So we are at the top of the hour, and I just want to thank everybody so much for joining. I hope you can tell I love talking about this stuff. So if you have any questions, please do reach out. We're happy to follow up. And as I said, we will have the presentation available for you. And if we can be of any assistance, just let us know. Until next time, take care.